Supermicrocomputer is once again at the center of intense market attention following a blowout earnings report that underscored just how powerful the current AI infrastructure cycle has become. The company delivered a massive top and bottom line beat, reporting non-GAAP EPS of 69 cents plus 35% year over year on revenue of $12.7 billion plus 123% year over year, far exceeding its prior guidance range and straight expectations. Even more importantly for sentiment, management raised full-year FY26 revenue guidance to at least $40 billion, reinforcing the view that SMCI is riding a multi-year wave of hyperscale and enterprise AI buildouts. The quarter highlighted extraordinary demand for Supermicro's AI-focused platforms. Management disclosed that AI GPU systems now account for more than 90% of total sales, reflecting the company's deep integration into next-generation data center deployments. Rack scale and cluster level wins with hyperscalers and large AI customers were described as well above guidance, validating Supermicro's strategy of rapid design to deployment execution. However, the results also exposed the core tension driving today's debate: record-breaking revenue growth versus extremely thin margins. Non-GAAP gross margin fell to 6.4%, pressured by unfavorable product mix tilted toward lower-margin GPU systems, expedite and logistics costs, tariffs, tight supply, and elevated component pricing. This margin compression has become the primary talking point among skeptics. Many argue that while SMCI is clearly winning volume, it may be sacrificing profitability in an increasingly competitive AI server market, where NVIDIA, AMD, and component suppliers retain significant pricing power. Management attempted to calm those fears by stating that gross margin is likely at or near a trough, sequential improvement is expected going forward, and long-term target remains double-digit gross margins. Adding to the bull case, Supermicro highlighted the growing contribution from its DCBBS business, which now represents about 4% of profit and carries gross margins above 20%. Investors see this segment as a critical lever that could structurally lift company-wide margins over time as it scales. Another area drawing heavy discussion is customer concentration. One hyperscale data center customer accounted for roughly 63% of revenue, and 86% of total sales came from the U.S. While this concentration reflects massive hyperscale wins, it also raises concerns about negotiating leverage, pricing power, and volatility if any large customer slows orders. To support growth and working capital needs, SMCI has strengthened liquidity through approximately $3.8 billion in new credit facilities and accounts receivable factoring programs. Bulls view this as prudent balance sheet management in a hyper-growth phase, while bears argue it underscores the capital intensity and thin margins of the business. The community split. Bullish camp views SMCI as a pure-play AI infrastructure giant, generating tens of billions in annual revenue. Believes the stock is massively undervalued relative to its sales base and long-term growth trajectory. Points to potential short squeeze dynamics, giving elevated short interest and repeated earnings beats. Views margin recovery plus DCBBS scaling as a powerful upside catalyst. Bearish, cautious camp focuses on sub-7% gross margins as structurally problematic, worries about heavy dependence on a small number of customers, questions whether SMCI can ever achieve durable pricing power. Some accuse large institutions or market makers of suppressing price action, fueling frustration over the stock's muted response to blockbuster numbers. Big picture. At its core, SMCI's latest report confirms one thing clearly: AI infrastructure demand is exploding, and Supermicro is one of the biggest volume beneficiaries. The unresolved question is whether that volume can translate into consistently strong profitability. That uncertainty is exactly why the stock has become such a lightning rod. To bulls, SMCI looks like a coiled spring, an AI powerhouse priced as if it were a low growth hardware vendor. To skeptics, it's a cautionary tale of scale without margins. Either way, Supermicro has firmly positioned itself as one of the most important and most controversial ways to play the AI data center boom.
Okay, so the stock is up 11.76%. This is Wednesday, the 4th of February 2026. But still, the post-market session, the pre-market session hasn't really started. So much of this data you're looking at right now is from yesterday. Yeah, much of yesterday and indeed the post-market session. It was a big day for the stock in terms of volume. You can see 50-day average is around 26 million, 42 million shares across the tape. Let's see what we have. Okay, so the stock is on this day on this 4 hour chart. The underlying trend on this 4 hour chart is severely bearish, and this strength it has right now is expected to remain in place up till the midday today, the fourth, and up till up till Thursday the fifth. Then that's after that we might be looking at the prospects of a consolidation. Nothing to the upside in terms of further expansion. But projections are saying, let's see what we have. Current price is $33. Projections here are saying, let's see, 30.84, 31.76, 32.34. Nothing currently to the upside as well. But previous projections were pointing to 35.91, 38.20, 39.62. We saw a gain of up to 12% at some point. Okay, no, it didn't print any intraday high. The last intraday high printed was 33.75. That was on the 23rd of January, 33.75. Okay, so let's see what we have. Momentum is expected to remain elevated at least up till midday today as well. After that, it may begin to contract. So there's a chance that the on this 4 hour chart, the stock might drop below its 10 period moving average by tomorrow, the 5th of February. Okay, but all in all, we have gathered the data on this daily chart and including its market grid and a couple of other things. Let's see. So this is the 10 period moving average, extremely bullish, but the derivatives are all still negative. Still negative. Momentum is decelerating rapidly. Deceleration in accelerate and is deceleration is accelerating. Parabolic move exhausting. Expect mean reversion. Okay, but the other moving averages, the short and intermediate the intermediate and medium term moving averages are still trending. They are gaining. Any gain above any value above 0.25 indicates the stock is that moving average is trending. So you can see the 21 period moving average and the 40 period moving averages are all above 0.25. Okay, let's see what we have. This is the market grid. It's trading outside of that market grid right now. That is why we have some of these things: extreme price pressure, momentum, exhaustion signals pull back. Yeah, because the market grid hasn't reacted yet, so we can read a lot of meaning into that. So we just all we have to do is just look at this trade setup, 2 to 8 weeks. So if it weakens towards 28.75, then it provides a buying opportunity. So your target will be $34 to $35, 55% probability. $38 to $40, 35% probability. $45, 20% probability within 6 months. Risk factors: margin compression could override revenue beats. Accounting concerns linger despite cleared audits. Market manipulation sentiment creates unpredictable volatility. Sector rotation out of AI infrastructure could pressure AI all rallies. Okay, so final probability summary: short-term pullback to $29 to $30, 65% probability. Test of 28.78, 45% probability. Rally continuation 25% to above $33. Where is it right now? Yeah, just slightly above that. Long-term recovery to 35 plus dollars, 50% in the next up to six up from in 6 month view. Okay, the extreme deceleration of its price pressure momentum one, that is the 10-period moving average, is your loudest signal. This is 6.62% pop. This 6.2 this 11.56% pop is likely exhaustion, not initiation. Okay, trade accordingly. All right. Okay. So just see what you make of SMCI, and thank you very much for watching this video.